Assalamu alaikum. Today's session is the ledger. Ledger accounts should be prepared for sales, purchases, and all other accounts that will appear in the general ledger. Income, expenses, assets, liabilities, and capital. So we have talked about general journal. Now we are talking about the ledger in general. And as we have seen before, we have seen the sales ledger, we have seen the purchase ledger, we have seen the cash book that serves as journal, as ledger, and we have talked briefly about the general ledger when we talked about general journal. Cash books is also part of the ledger, as we said. Ledger defined as the book that contains all the different accounts of an organization, providing a permanent summary of all the transactions entered in journals. So it's a permanent record, permanent summary of all entries made to the journals. Ledger is arranged so that transactions can be grouped by customer, supplier, and all type assets, liabilities, income, expenses, or capital. So, if you remember when we were talking about the accounting definition, we said that we have entries, then we have to group them and classify them. The ledger is doing the classification and the sorting of them. So, we will have transaction by the customer, as we have seen in the sales ledger, by the supplier, as we seen in the purchase ledger, or we have it by type, assets, liability. So the customer would be asset, and the supplier would be liability, but also income, expenses, and capital. Process of transferring journal entries to the ledger is called posting. When we transfer any entry from the journal to the ledger, it's posting. We have talked about this, but it wasn't explained as specific as we are doing now. Ledger accounts are usually arranged in a T-shaped account to differentiate between the debit and credit. We will see also that there will be a different shape, but later in this session. The double entry bookkeeping. Each transaction will affect two ledger accounts. As we know, any entry will have debit side and credit side. The debit side will go to one account and the credit side will go to another account. For every entry to the debit side, there must be corresponding credit entry and vice versa, which means that for every entry to the debit side, there must be corresponding credit entry and vice versa. If you did a debit entry, there should be a credit entry. If you did a credit entry, it should be a debit entry. This is how we call it double entry bookkeeping. It's important to determine whether the entry is debit or credit when you do the posting. You need to find out should be put in the right side or the left side, that's credit or debit. Easy way to decide and remember is cash or anything of value taken out from the business is credit. Remember, if you take anything, it's a credit. Cash or anything of value coming in to the business is debit. So we are talking about cash or anything of value that is asset. Anything taken from assets is credit. Anything added to assets is a debit. But in any entry, the party who's giving is credit and the party who's taking is debit. Recording purchase in the ledger. Trade payable account should be opened for each supplier. We're talking about credit purchase. And in the general ledger, open purchase account to record all purchases, cash and credit. Cash book, cash and bank to record payments made for cash purchases, including checks and transfers. We have cash purchases and on-credit purchases. Cash purchases can be paid through different ways, including checks and transfers. Still cash, and it will be recorded in the cash book. The credit purchases will be recorded in the purchases journal, as we have discussed earlier. Cash purchases are not recorded in the purchase journal, and its total is transferred to the purchase ledger account in the general ledger at the end of every month. So we have two ways to record purchases. On credit purchases, we'll go to the purchase journal, then it will be transferred to the purchase account in the general ledger. Cash purchases, regardless if it's paid by cash or by bank transfer or by check, it is recorded in the cash book but not recorded in the purchase journal and transferred at the end of the month by total to the purchase account in the general ledger. Let's see this example. In the cash book, we have a cash purchase in cash of $40, and June 11 we have $20 cash purchase, and in June 23 we have paid through the bank for $30 of purchase. If you look to the purchase account, this column is considered the analysis of cash purchases. Here in the purchase account, at the end of the month, June 30, we have total of cash purchases that's entered to the purchase account in the general ledger. Then we have $30 of cash purchases from bank entered to the purchase account in the general ledger. So cash purchases are entered to the ledger, general ledger purchase account at the end of the month. If you want to see how much we purchased in cash, look to the analysis column in the cash book. Purchases will increase the inventory while purchases returns will reduce it. We know that we buy goods to be sold. If you bought goods, you are increasing your inventory. Purchases increasing inventory. Purchase returns is taken out from inventory that reduce it. Cash purchases returns shall be recorded in the cash book by transaction, and the month total will be posted to the purchase return account in the general ledger. Same thing, like with cash purchase returns. Enter to the cash book because we recover our cash. If it's cash, we recover our cash, regardless if it's bank or cash. Then, by end of the month, use the analysis column total to record it in the purchase return account in the general ledger. Look to this example. We have purchase return on June 18 of $10. At the end of the month, the total is posted to the general ledger purchase return account June 18 cash return. Remember, we say posting because cash book is used as journal and as ledger. In this case, it's considered journal and we post from it to the purchase account or purchase return account in the general ledger. Credit purchases requires two sets of double ledgers. First, to record the amount owed to the trade payable. Second, to record the payment to the trade payable. At the end of every month, total of the purchases journal is posted to the debit side of the purchase account in the general ledger. For each supplier listed in the purchases journal, credit its trade payable account for each purchases on credit line. So we have the purchase journal, we record entry by entry, but every entry has to be posted to the trade payable account, while the total of the purchases journal is posted to the purchase account in the general ledger. Let's see this. This is an example of the purchase journal. We start with date, description, invoice number, and amount. We have two transactions, June 2nd and June 16. Beta Company invoice $3,911,000, and Sandy Company invoice number 9001 and purchase of $500. Total is $1,500. The $1,500 will be transferred to the purchase account in the general ledger. Purchase account general ledger, we have previous entries. These are the two cash, and all entries posted on June 30, end of the month. June 30, purchase journal $1,500. In the purchase ledger, we have the two suppliers who are trade payables. Beta Company is credit of $1,000 and Sandy Company is credit of $500. Purchase return journal, same thing. We have the journal, we have the entries. Beta have decided to return item. The company have decided to return to Beta Company goods worth $100, and Sandy Company received returns of $50. If you remember, sales returns are recorded via credit note. So this column for credit note, and these are the credit note numbers. Credit notes are issued by suppliers, not issued by the business. That's why the serial is different. We have total returns of 150, 100 to Beta Company and 50 to Sandy Company. In the purchase return, we have return of 10 of cash, and we have 150, that's total of the purchase journal that's posted at the end of the month to the returns, purchase returns account in general ledger. In Beta Company, we have bought $1,000 and we have returned 100 purchase return on June 25th, and to Sandy, we have returned $50 on June 30th, and we bought 500. On the end of the month, we have decided to pay the two vendors. We paid $500 to Beta Company, and we paid $200 to Sandy Company. In the cash book, you can see the two entries, $500 to Beta and $200 to Sandy. So this reflects the two sets of entries. We did the entry to record the purchase and the amount owed to the two suppliers, and then we did the purchase return and we did the pay. Recording sales in the ledger, only credit sales recorded in the sales journal. Same thing like with purchases. On credit only recorded in the sales journal, while cash are recorded in cash book and posted at the end of the month to the sales ledger. Same like purchases, but this is the other side. Look here, cash book, we have two cash sales, one in cash and one in bank, and the total is 35 and 60, and it's posted to the sales account 35 cash and 60 bank. Sales returns of cash sales are recorded in the cash book by the transaction, and the total is transferred, posted to the sales ledger account in the GL. Look to this example, we have sales return of $15 in cash and credit sales. Let's see the sales journal. We have here date, description, invoice number, and amount. On June 5th, the business sold to Tariq Company, of which his account number is 33311 and the invoice is CS111 and the amount sold is $300. On June 19th, Saad Company the number is 33221 and the invoice is CS112 because this is the same number of the business. It's following the same city. And the sold amount is $200, total is $500. In the sales account, you will see that the two cash sales that we did earlier, plus the total of the sales journal, $500 sales journal, June 30th. sales return will be the same. Oh, I'm sorry, let's look to the sales ledger, Tariq account. Received $300 sales, and Saad's account received $200 sales. This is the sales ledger, not the general ledger. These are considered trade receivables. Sales returns journal have date, description, credit note, and amount. Credit note is the business, so it will have the same serial number. Tariq have returned one item on June 7th, wrong item of $50. And on June 10th, Tariq again returned unfit item of $50, and the serial number is CRS credit sale 31 and CRS 31 and CRS 31. Total is $100. Look to the sales returns account in the general ledger. We have the cash one, $15, and we have the $100 that's total of the sales return journals, regardless who's the customer returning. We look to Tariq's account in the sales ledger. He bought items of $300. He did 2 returns, each of $50, and he paid on June 30 $100. His balance is $100. Total is $300. Total is $300. His balance is carried forward to be the beginning of the following month balance. Cash book, $100 were received from Tariq on June 30th. Other entries for expenses, income, assets, and liabilities are recorded in the GL on the date they occur. We have seen sales, sales return, purchase, purchase return. Now other entries for expenses, income, assets, and liabilities are recorded in the general ledger according to their date. We will see example here in the cash book. We have paid for rent from the bank. We have paid for electricity, cash. We have paid for wages from the bank. Rent is an expense account in the GL. It's $500 debit and the bank is credit. Electricity in the GL, $120 debit and the cash is credit. Wages, $3,000 debit and bank is credit. And we follow the same dates in the cash book. Purchases of required items not intended for sale is an expense. For example, I bought fuel for the vehicles. Credit purchase of $200 for vehicle fuel from Dana Company. Vehicle expenses will be debit and Dana Company is credit and $200. Dana Company in the GL, Dana Company is not a trade payable, it's a GL. It's an accounts payable. And it's credit and the vehicle expenses is debit of $200. Posting income received. This is another thing in the ledger. We received rent income and we received commission income. The rent was received in cash and the commission was received in bank. We just post them to the relevant general ledger accounts. General ledger have rent received account, cash $200, and commission received, cash $500. It's bank, not cash. Personal drawings by owner will reduce the assets and accordingly will reduce the capital because the total of the balance sheet will be reduced. In the cash book, there was a drawing of $1,000 and the drawing account become debit of $1,000. This is cash. Sometimes the owner will decide to make drawing from the stock. So from the stock, we credit the purchase account in the general ledger of $100. That's the drawings for the owner. And the drawing will be debit also for $100 from the purchases plus the $1,000 for the cash. With this, we have seen examples of all the ledger transactions. Now we will talk about balancing off the ledger. Each ledger account has to be balanced off at the end of the accounting period. Each month, to compare total debits and total credits. Balance of ledger accounts with debit balance. This is an example for balancing ledger with debit balance. Equipment account. Equipment is an asset and its balance should be debit. On Jan 10th, the business purchased $100 of equipment in cash. Jan 15th, purchase of $2,000 equipment from the bank. And on January 20, on credit from SJ Company, they bought $1,500 furniture. Total is $3,600. The balance, there is no credit entry, so the balance would be equal to the total of the debit side. So the $3,600 balance carried forward, and in the start of the following month, balance moved forward. The use of running balance format instead of T format provides balance after recording each transaction. We will see this account using the running balance format. The running account presentation of the equipment account, we have date, we have details, we have debit, credit, and bill. This is unlike the traditional T account. On January 10, there was a cash purchase of $100. Then the balance would be debit of $100. On January 15, there is another debit for bank and $2,000. So the total would be the sum of the two transactions. This one plus this one, that's $2,100 debit. On January 20, there is another purchase from SJ Company of $1,500. So the balance would be the old balance plus the new transaction equals the new balance, $3,600. So for every transaction, you can get the balance. With this, we have covered all the transactions of the ledger and balancing of the ledger. With this, we have finished, and we'll see you in the next session that will be trial balance, inshallah. Thank you.